Hey guys, tonight we're going to dive into a part of history that's often glazed over in textbooks. A world of grand ambitions and even grander downfalls. Why Renaissance banking was a horrifyingly risky business. Forget the image of stoic, wealthy bankers counting their gold. Imagine instead a high-stakes gamble where entire family fortunes could vanish overnight, and the consequences of failure were utterly devastating. This isn't a story of boring numbers. It's a thrilling, terrifying plunge into the chaotic financial heart of the Renaissance, where every transaction was a dance with disaster. You might think your online banking is stressful, but trust me, you wouldn't last a single afternoon trying to manage a medieval letter of credit. So, before you get comfortable, take a moment to like the video and subscribe, but only if you genuinely enjoy what I do here. Now, I'd love to know where you're listening from and what time it is for you right now. Drop it in the comments. Now, dim the lights. Maybe turn on a fan for that soft background hum, and let's ease into tonight's journey together. You're a merchant in Florence, or Venice, or perhaps London, in the bustling heart of the Renaissance. The air is thick with the scent of spices, wool, and human ambition. Ships laden with exotic goods arrive daily, and great cathedrals rise stone by stone, all funded by a revolutionary yet terrifyingly fragile new system banking. This isn't banking as you know it, with FDIC insurance and digital transfers. This is a personal venture, often family-run, where your reputation is your only collateral, and every loan, every investment carries a risk that could easily ruin you. The perilous promise of riches beckons, but the lurking shadows of ruin are far more numerous. Imagine you're the head of a banking house, perhaps the legendary Medici, or the less fortunate Peruzzi. You're not just lending money, you're operating a vast, complex network across cities and kingdoms. Your agents are in Bruges, your correspondents in Naples, your ships sailing to Alexandria. Each transaction is a leap of faith, a whispered promise carried across vast distances on horseback or by unreliable ship. There are no instant confirmations, no traceable digital footprints. A simple delay in communication, a lost messenger, or a storm at sea could unravel a meticulously planned deal, leaving you holding the bag, or rather, an empty vault. One of the most horrifying risks was the sheer lack of reliable information. Today, you can check credit scores, market trends, and political stability with a few clicks. In the Renaissance, you relied on rumors, letters that took weeks or months to arrive, and the personal judgment of your agents, who themselves might be compromised or simply mistaken. You might lend a vast sum to a distant prince, based on a single letter of recommendation from a business associate, only to find out months later that the prince's treasury is empty, or he's been overthrown in a coup. Your investment, your family's wealth, simply vanishes into the ether. There's no Bloomberg terminal to warn you of an impending political upheaval, no Reuters feed to tell you the harvest failed in a distant land. It's all guesswork, instinct, and a healthy dose of prayer. You might even find yourself wishing for the simple, straightforward risks of being a spice merchant, where your biggest fear was just a leaky ship. Then there's the political instability. The Renaissance was a period of constant, brutal warfare and shifting alliances. Cities were besieged, kings deposed, and entire regions plunged into chaos. As a banker, you were often deeply entangled with these volatile powers. Princes and monarchs, perpetually short on funds for their armies, would borrow heavily from banking houses. These loans were colossal, often representing a significant portion of a bank's total assets. But if a prince lost a war, or was assassinated, or simply decided he didn't want to repay his debts, your bank was in existential trouble. There was no international court, no legal recourse that could force a sovereign ruler to pay up. Your only leverage was often your continued willingness to lend, a terrifying game of chicken. Consider the sheer scale of these loans. The Bardi and Peruzzi families, major Florentine bankers in the 14th century, lent enormous sums to King Edward III of England to fund his wars against France. When Edward defaulted, it wasn't just an inconvenience. It triggered the collapse of both powerful banking houses, dragging countless smaller investors down with them. This was a domino effect on a grand scale, wiping out generations of wealth and causing widespread economic panic. Historians still debate the exact reasons for Edward III's defaults, whether willful or due to genuine insolvency, but the consequence for the bankers was undeniably catastrophic. Another unique horror of Renaissance banking was the personal nature of debt and default. There were no limited liability corporations. If your bank failed, your personal fortune, your family's land, even your very freedom could be on the line. Debtors' prisons were a very real threat, a grim fate that awaited those who couldn't repay their loans. Imagine a prominent banker, once a pillar of society, rotting in a dungeon because a distant king decided not to honor his word. The shame, the ruin, and the physical suffering were very real consequences, making every major loan a terrifying personal gamble. It's almost enough to make you long for the simple, predictable challenges of a baker, where your worst problem is just a burnt loaf. The sheer logistical nightmares were also horrifying. Without modern communication, how did you know if a payment had been made in Lyon? How did you transfer funds from Genoa to London without physically moving vast sums of gold, which was itself incredibly risky due to bandits and pirates? The solution was the bill of exchange, a revolutionary financial instrument, but one fraught with its own dangers. It was essentially a promise to pay a certain sum at a future date in a different location. This allowed merchants to travel without carrying large amounts of cash, but it relied entirely on trust and the solvency of multiple parties across a vast, unreliable network. If one link in that chain broke, the entire transaction could unravel. And let's not forget the moral and religious constraints. The Catholic Church generally prohibited usury, the charging of interest on loans, while bankers found clever ways around this, disguising interest as exchange fees or gifts. It added another layer of legal and spiritual peril. You operated in a gray area, constantly navigating the wrath of the church and the moral judgments of society. A public accusation of usury could damage your reputation, leading to a loss of trust from clients and ultimately ruin. This constant tightrope walk between profit and piety was a unique pressure point for Renaissance bankers. Even natural disasters posed a terrifying threat. A devastating famine in one region could cripple agricultural output, impacting trade and the ability of peasants and nobles alike to repay their loans. A widespread plague could decimate populations, leading to labor shortages, economic contraction, and widespread defaults. These were forces beyond any banker's control, yet they could unleash financial chaos that wiped out fortunes in an instant. You're not just worried about market fluctuations, you're worried about the wrath of God and the caprices of nature. The audacious scale of their ambition, fueled by the promise of immense wealth, blinded many to the inherent systemic risks. They were pioneers in a new, uncharted financial landscape, building bridges of credit across a vast and unpredictable world. But for every success story, there were countless failures, quiet ruin, and spectacular collapses that echoed through the streets of Europe. Renaissance banking was a thrilling, often glorious, but always horrifyingly risky business, where fortunes were made and lost with a terrifying swiftness, and the price of failure was paid not just in coin, but in shattered lives and lost legacies. You've glimpsed the chaos of Renaissance banking, where grand ambitions clashed with terrifying realities. Now, let's zoom in on one of the most insidious dangers credit's treacherous tangle. Imagine a world where promises were as binding as a king's decree, yet as fragile as a spider web, and where the trust you placed in a handshake could lead to your utter ruin. This isn't about simple loans. It's about a financial system built on layers of interconnected promises, where one broken link could bring down an entire chain. In the Renaissance, ready cash was scarce. Gold and silver coins were heavy, dangerous to transport, and limited in supply. To facilitate the booming trade across Europe, bankers developed intricate systems of credit. This meant that instead of exchanging physical money, merchants and princes would make promises to pay at a future date, often in a different city, using instruments like the bill of exchange. You, as a banker, were at the heart of this system, acting as a trusted intermediary, a living ledger of debts and credits spanning continents. Here's where the tangle begins. A merchant in London might want to buy wool from a supplier in Florence. Instead of sending gold, he'd pay a London banker, who would then issue a bill of exchange, a written promise to pay the Florentine supplier a certain sum at a future date, perhaps in 3 months. The Florentine supplier would then take this bill to his local Florentine banker, who would discount it, pay a slightly lower sum immediately, and then wait for the London banker to honor the bill. This sounds efficient, right? But now imagine this process happening hundreds, thousands of times, with dozens of bankers involved. The fundamental horror was the lack of transparency and centralized information. You had no way of knowing the full financial health of the person or entity you were extending credit to. Was that Venetian merchant truly solvent, or was he overextended, relying on a dozen other unfulfilled promises? Was that German prince really going to repay his loan, or was he secretly planning another war that would drain his coffers dry? You operated largely on reputation and personal intelligence, often relying on letters from distant agents who might be biased, ill-informed, or even outright dishonest. It was like building a house of cards on quicksand. You're effectively a human search engine trying to find a needle in a haystack, and that haystack is constantly on fire. Consider the ripple effect of a single default. If the London merchant, for instance, suddenly went bankrupt, the London banker might not be able to honor the bill of exchange he issued. The Florentine banker, who had already paid his client, would then be out a significant sum. This loss could then trigger his inability to pay his creditors, creating a cascading chain reaction of defaults across the entire network. One merchant's misfortune, or one prince's broken promise, could bankrupt an entire banking family hundreds of miles away, who had no direct dealings with the original defaulter. It was a terrifyingly interconnected web of trust, where the failure of one thread could unravel the whole tapestry. A unique and terrifying aspect was the concept of double payment, or triple payment risk inherent in early bills of exchange. Since there was no single universally recognized system for tracking payment, a dishonest or desperate merchant could, theoretically, present the same bill of exchange for payment in multiple locations, or issue multiple bills for the same underlying transaction, hoping to get paid more than once before the system caught up. While not common among reputable bankers, the sheer possibility created an underlying layer of distrust and meticulous cross-referencing that consumed vast amounts of time and resources. Historians still debate how widespread such deliberate fraud was versus simple errors or communication breakdowns, but the fear of it was very real and contributed to the inherent risks. Then there was the constant threat of political interference. Princes and powerful lords, perpetually in debt, might seize a banker's assets or simply declare their debts null and void. They could confiscate goods, imprison agents, or even expel banking families from their cities. You might have a vast sum owed to you by the King of France, only for him to suddenly declare war on your home city-state, making repayment impossible and your assets within his borders fair game. There was no independent judiciary, no international law that could protect your investments from the whims of absolute power. It's like lending your entire life savings to a notoriously unpredictable neighbor who also happens to own a tank. The sheer volume of paperwork, all done by hand, added another layer of peril. Every transaction, every loan, every repayment had to be meticulously recorded in ledgers, copied, and often sent by messenger across vast distances. Mistakes were inevitable. A misplaced decimal, a forgotten entry, or a miscalculation could throw entire accounts into disarray, leading to disputes, accusations of fraud, and potentially significant financial losses. The human element, with its inherent fallibility, was a constant source of anxiety. And let's not forget the moral hazard, because credit was so pervasive and fortunes could be made so quickly. There was a temptation to take on excessive risk. Bankers might lend too much, too often, to too many unreliable parties, hoping that the sheer volume of transactions would outweigh the inevitable defaults. This kind of reckless behavior, while potentially lucrative in the short term, often led to spectacular collapses when the inevitable downturn occurred. The allure of quick riches blinded many to the underlying dangers. The very concept of a family-run banking house, while fostering trust and continuity, also concentrated risk. If the head of the family died suddenly, or if several family members were captured or killed during a conflict, the entire banking operation could be thrown into disarray. Succession plans might be unclear, agents might lose confidence, and rival families might seize the opportunity to undermine the business. The individual fate of the family was inextricably linked to the bank's survival, making it a terrifyingly personal enterprise. You might find yourself wishing you were back scrubbing mud from a medieval peasant's boots. At least then, your life wasn't on the line every time someone signed a piece of paper. This elaborate dance of credit, while crucial for the economic expansion of the Renaissance, was built on an incredibly precarious foundation. It relied on a delicate balance of trust, communication, and political stability, all of which were in constant flux. Every handshake was a binding agreement, every bill of exchange a leap of faith across unpredictable landscapes. The treacherous tangle of credit meant that even the most prudent banker could be brought down by the distant misfortunes or malicious actions of others, making the pursuit of wealth a horrifyingly risky business indeed. You've seen how credit's intricate web could ensnare even the most cautious banker. Now, prepare to confront the ultimate terror that haunted every financial transaction in the Renaissance, the shadow of default. This isn't just about a missed payment. It's about the brutal, often public, and utterly devastating consequences that awaited both bankers and debtors when loans went wrong. Imagine a financial system where failure didn't just mean bankruptcy, but ruin, imprisonment, and social ostracism. In an era without modern consumer protection laws or sophisticated bankruptcy courts, a default was a catastrophic event. For the debtor who couldn't repay, the consequences could range from severe financial penalties to outright imprisonment. If you were a merchant who defaulted on a loan from a powerful banking house, your reputation would be shattered. Other merchants would refuse to deal with you, and your credit, the very lifeblood of your business, would dry up instantly. You might be forced to sell off all your assets, including your home and family heirlooms, just to cover a fraction of your debts. But for many, especially those of lower social standing, the grim reality was debtor's prison. These weren't comfortable holding cells. They were often squalid, overcrowded, and disease-ridden dungeons. You could languish there for years, sometimes for the rest of your life, unable to work, unable to support your family, simply because you couldn't pay back a sum of money. Your family would be left destitute, disgraced, and often forced into poverty. It was a terrifying deterrent, a public spectacle of failure designed to enforce financial obligations through sheer terror. You can almost feel the damp, cold walls and smell the stale air just thinking about it. For the banker, a significant default was equally horrifying, perhaps even more so due to the domino effect it could trigger. If a major client, say a king or a powerful merchant, defaulted on a massive loan, it could immediately jeopardize the banker's own solvency. Remember that treacherous tangle of credit we talked about? One large default could mean the banker couldn't honor his own obligations to other clients or creditors, leading to a cascading series of failures. It was like pulling a critical thread from a finely woven tapestry. The whole thing could unravel before your very eyes. The loss wasn't just financial. A banker's reputation was his most valuable asset, built on years, often generations, of trust and reliability. A major default could instantly shatter that reputation, leading to a rapid loss of confidence from other merchants, investors, and even the powerful families who might have entrusted their fortunes to the bank. Clients would withdraw their deposits en masse, fearing for their own money, leading to a bank run, a terrifying phenomenon that could quickly drain a bank's reserves and force its collapse. A unique and often brutal aspect of default in the Renaissance was the public humiliation and symbolic destruction that could accompany a bank's failure. In some Italian city-states, when a banker went bankrupt, his bank's counter or banco would literally be broken, hence the origin of the word bankruptcy. Imagine the public spectacle, your family's name, once synonymous with wealth and power, now dragged through the mud as your physical establishment is dismantled, a stark visual representation of your ruin. This wasn't just a legal procedure, it was a deeply personal and scarring public shaming. Historians still debate the precise frequency and severity of these public bankruptcies versus quieter defaults. But the threat of such an event loomed large over every banking house. Then there was the threat of vengeance. In a world where personal honor was paramount and legal recourse often slow or ineffective, a defaulted loan could easily escalate into violent retribution. A powerful banking family might resort to strong-arm tactics, even hiring mercenaries to intimidate a defaulting debtor or to seize assets by force. Conversely, a defaulting prince might retaliate against a banker who pressed too hard for repayment, confiscating property or even imprisoning family members. The lines between finance and brute power were often blurred, making every large loan a potential blood feud waiting to happen. You might find yourself missing the simple, albeit pungent, task of cleaning out a stable. At least there, the worst you faced was a kick from a horse, not an assassin. Consider the psychological toll of this constant threat. Every major loan was a source of acute anxiety. You lay awake at night, tallying figures in your head, replaying conversations, wondering if that distant prince would truly honor his word, or if that merchant's latest venture would succeed. The weight of your family's legacy, the livelihoods of your employees, and the trust of your clients all rested on these precarious transactions. It was a perpetual state of high alert, a low hum of dread beneath the surface of every seemingly prosperous day. The lack of robust, standardized accounting practices also exacerbated the problem. While double-entry bookkeeping was developing, it wasn't universal, and financial records could be complex, disorganized, or even deliberately obscured. This made it difficult to accurately assess risk, identify problems early, and recover debts effectively. A debtor could easily hide assets or manipulate figures, making the recovery process a torturous, often futile, endeavor. It was like trying to navigate a dense fog, blindfolded. Ultimately, the shadow of default meant that Renaissance banking was a profoundly personal and high-stakes game. There were no safety nets, no government bailouts. Failure wasn't just a business setback. It was often a complete collapse, not only of wealth, but of reputation, social standing, and personal freedom. This terrifying reality forced bankers to be incredibly shrewd, ruthless, and often incredibly lucky. It shaped the very fabric of their decisions, making every investment a gamble with truly horrifying consequences. The specter of ruin was a constant companion, a chilling reminder that in the world of Renaissance finance, the promise of riches was always shadowed by the very real threat of utter devastation. You've witnessed the personal terror of default. Now, let's widen our gaze to encompass an even grander, more chaotic stage beyond borders, beyond control. Imagine trying to run a vast financial empire when your communications took weeks. Your currency constantly fluctuated, and every shipment of cash was a magnet for thieves. This is the horrifying reality of medieval international finance, a logistical nightmare where control was an illusion and risks lurked at every turn. Your banking house in Florence or Venice might have branches or agents in Bruges, London, Naples, and even distant Alexandria. This network was essential for the thriving international trade of the Renaissance. Merchants needed to move funds and goods across vast distances without the crippling risks of physically transporting huge quantities of gold or silver. The solution, as we discussed, was the bill of exchange, a revolutionary instrument, but one that opened up a terrifying Pandora's box of international complications. Consider the sheer time lag in communication. A letter from your agent in Bruges, detailing a large transaction or a potential default, could take weeks, even months, to reach you in Florence. By the time you received the information, the situation might have drastically changed. A client who was solvent when the letter was written could be bankrupt upon its arrival. A political uprising might have occurred, seizing assets you thought were secure. You were constantly making decisions based on outdated information, essentially flying blind across a vast, unpredictable continent. There was no internet, no telegraph, just a lone rider on a weary horse, the fate of your fortune resting on his safe, swift passage. It was like trying to manage a global stock portfolio with updates delivered by carrier pigeon. Then there was the currency chaos. There was no single universally accepted currency. Every city, every kingdom minted its own coins with varying weights, purities, and denominations. You'd be dealing with Florentine florins, Venetian ducats, English pounds, French livres, and countless local coins, all fluctuating in value against each other. As a banker, you had to be an expert in foreign exchange, constantly calculating conversion rates, factoring in commissions, and anticipating future devaluations. A slight miscalculation or an unexpected shift in a currency's value could wipe out your profits or even incur significant losses on large transactions. It was a dizzying, error-prone dance with numbers that could change without warning. The physical transfer of value, even with bills of exchange, remained a huge risk. While bills reduced the need for physical gold, large sums still occasionally had to be transported. Imagine sending a convoy of wagons laden with coin across bandit-infested mountain passes or pirate-ridden seas. These shipments were prime targets. A single successful raid could mean the complete loss of a fortune, and there was often little recourse. Your armed guards might be brave, but they were no match for a well-organized band of brigands or a heavily armed pirate ship. You could lose everything in a flash of steel and a cloud of dust. A unique and terrifying aspect of international banking was the legal patchwork. There was no unified international law. What was legal in Florence might be forbidden in London. Contracts valid in Venice might not be enforceable in Castile. If a dispute arose with a client or another banker in a foreign land, you were at the mercy of local courts, which could be biased, slow, or outright corrupt. Recovering debts across borders was a Herculean task, often requiring lengthy negotiations, personal appeals to powerful lords, or even outright intimidation. Historians still debate the effectiveness of the various merchant courts and guilds in resolving international disputes, but for individual bankers, navigating this legal maze was a horrifying gamble. Beyond the legalities, there was the moral ambiguity of distant agents. You entrusted vast sums and critical information to men far from your direct oversight. How could you be sure they were truly loyal, honest, and competent? They might collude with local merchants, embezzle funds, or make reckless decisions that jeopardized your entire operation. Your control was tenuous at best, built on layers of correspondence and personal trust, which could be easily betrayed. It's like running a multinational corporation by relying solely on snail mail and hoping everyone stays honest. You might find yourself yearning for the simple, tangible problem of a stack of moldy ledger books. At least then, you could physically see the problem. The very concept of a branch office was fraught with peril. These branches, often run by family members or trusted partners, operated semi-independently, making their own local loans and investments. While this extended the bank's reach, it also decentralized risk. A bad decision by a manager in the Bruges branch could bring down the entire Florentine parent company, even if the Florentine operations themselves were perfectly sound. Your fate was tied not just to your own decisions, but to the prudence or recklessness of distant relatives and associates. Finally, there was the constant threat of expropriation or forced loans by foreign powers. A king suddenly in need of funds for a war might simply request a massive loan from your branch in his city, a request that was impossible to refuse without risking your entire operation and potentially your agents' lives. Or he might simply seize your assets, claiming them as war reparations or for some fabricated slight. Your foreign operations were always vulnerable to the whims of powerful, often desperate, rulers who held absolute power within their own territories. You were a pawn in their geopolitical games, and your assets were always on the table. Running a Renaissance banking empire across borders was a breathtakingly ambitious, yet horrifyingly uncontrolled endeavor. Every layer of distance, every border crossed, every new currency encountered added exponential layers of risk. It was a constant battle against time, unreliable information, political instability, and the sheer unpredictability of human nature. The promise of international riches was intoxicating, but the perils were omnipresent, making success a testament not just to financial acumen, but to sheer luck and an iron will. You've grappled with the logistical nightmares of international banking. Now, let's consider the single greatest, most voracious consumer of Renaissance banking fortunes, war's insatiable appetite. Imagine pouring vast sums of your family's wealth into a conflict, knowing that the fate of your entire enterprise hinges on the capricious tides of battle and the unpredictable whims of kings. This isn't just about making a risky loan. It's about betting everything on the outcome of a bloody, drawn-out chess match where the pieces are living, dying men. Kings and princes in the Renaissance were perpetually at war, whether defending their borders, expanding their territories, or settling dynastic squabbles. Conflict was the norm, not the exception. And war, then as now, was incredibly expensive. Armies needed to be raised, equipped, fed, and paid. Mercenaries, often the backbone of these forces, demanded hefty sums. Fortifications had to be built or repaired, siege engines constructed, and weapons procured. All of this required vast quantities of coin, and the primary source for such funds were the burgeoning banking houses. As a banker, you were often drawn into these conflicts not by choice, but by necessity. A powerful monarch might request a loan, a polite term for a demand that was impossible to refuse without risking your assets, your business, and perhaps even your life. Refusing a king's plea for funds could lead to confiscation of your property, expulsion from his lands, or even imprisonment. So, You lent, often at great risk, hoping that victory would lead to repayment, and perhaps even greater favor. It was a terrifying Faustian bargain, where your prosperity was tied to the outcome of brutal violence. Consider the sheer scale of the loans. The largest banking families, like the Medici, the Fugger, or the Peruzzi, routinely lent sums that would be astronomical even by today's standards. These weren't small, manageable debts. They were the equivalent of funding entire national budgets for years. When Edward III of England defaulted on his massive loans to the Bardi and Peruzzi, it wasn't just a financial setback, it was a systemic shock that contributed to the collapse of both powerful Florentine banking families whose combined losses were catastrophic. They had poured everything into his wars, and when he lost, they lost everything. The horrifying truth was that you had almost no control over the outcome of your investment. Once the gold left your vaults and entered the hands of a monarch, its fate was decided on distant battlefields by generals and soldiers. A single lost battle, a poorly executed siege, or a betrayal could wipe out your investment in an instant. Your fortune rested on the bravery of knights, the skill of commanders, and the sheer luck of war. You could calculate risks, analyze alliances, and assess a monarch's strategic acumen, but ultimately, the outcome was beyond your influence. A unique and particularly insidious aspect of funding war was the long lead time and unpredictable nature of repayment. A king might promise repayment after a victorious campaign, but campaigns could last for years, draining your resources while you waited, or victory might be elusive, leading to more borrowing, piling up debt upon debt. Even if a king won, his treasury might be depleted, forcing him to repay slowly, in installments, or even in kind, with land or privileges that were difficult to monetize quickly. This meant your capital was tied up for extended, often indefinite periods, preventing you from making other, potentially more lucrative, investments. Historians still debate the specific financial strategies employed by various monarchs to delay or avoid repayment to their bankers, but the frustration and financial strain on the banking houses were immense. Then there was the constant threat of inflation. War often led to increased taxation, disruptions in trade, and the debasement of currency as desperate rulers minted more coins with less precious metal. This meant that the money you were eventually repaid with might be worth significantly less than the money you originally lent, eroding your profits and further exacerbating your losses. You weren't just worried about getting your money back, you were worried about what that money would actually be worth when it finally returned to your coffers. It's enough to make you miss the simple, predictable, if sometimes boring, life of a monastery scribe. Furthermore, wars didn't just impact the borrowing monarchs. They devastated the very economic landscape upon which your business relied. Trade routes were disrupted, cities were sacked, agricultural lands were laid waste, and populations decimated. This meant fewer merchants to trade with, fewer producers to finance, and fewer people able to repay their existing debts. The very foundation of your banking operations could crumble as the cannons roared and armies marched. You were funding the destruction of your own market. Even neutrality offered little protection. If your banking house operated in a city-state that tried to remain neutral, it could still find its assets seized by a warring power passing through, or its trade routes cut off. You were always caught between warring factions, trying to placate powerful rulers while simultaneously protecting your investments. It was a terrifying tightrope walk, with immense fortunes balanced precariously on either side. Ultimately, Renaissance banking's deep entanglement with warfare was its most horrifying risk. The sheer scale of the loans, the complete lack of control over military outcomes, the unpredictable nature of repayment, and the devastating impact of conflict on the broader economy all combined to make war an insatiable, ruinous devourer of banking fortunes. Many powerful families rose to prominence by financing war. But just as many were dragged down into ruin when the tide of battle turned against them, leaving behind only the echo of their once grand ambitions, swallowed whole by the endless appetite of conflict. You've witnessed how war devoured banking fortunes. Now, let's explore the fundamental, yet terrifyingly fragile, bedrock of the entire Renaissance financial system, the tyranny of trust. Imagine a world where your entire fortune, your family's legacy, and your very standing in society hinged on the spoken word, a signature on a simple piece of paper, and the personal integrity of individuals thousands of miles away. This isn't about contracts backed by legal systems. It's about a deeply personal web of faith where betrayal or misfortune could shatter everything. In an era without robust legal frameworks, centralized databases, or instant communication, trust was paramount. When you, as a banker, issued a bill of exchange, accepted a deposit, or extended a large loan, you were essentially betting on the character and solvency of another person. Your personal relationship with merchants, nobles, and other bankers was your most valuable asset. A good reputation, built over generations of honest dealings, was literally worth more than gold. Conversely, a reputation for unreliability or dishonesty would quickly doom your business. Consider a transaction. A merchant from Bruges wants to pay a supplier in Venice. He goes to his local banker, exchanges money, and receives a bill of exchange drawn on a Venetian correspondent. This bill isn't backed by a central bank or a government guarantee. It's a promise, an agreement between specific individuals. The Venetian banker accepts it, knowing that his Bruges counterpart is a man of his word, and that the merchant has sufficient funds. If any link in that chain of trust breaks, the entire system grinds to a halt. It's like building a skyscraper entirely out of handshake agreements. The horrifying truth was that this immense reliance on personal trust made the system incredibly vulnerable to individual failures. If a trusted correspondent in a distant city died unexpectedly, or if he proved to be dishonest, or if his own business collapsed due to unforeseen circumstances, the ripple effect could be devastating. You might find yourself holding worthless bills of exchange, unable to recover the funds you had paid out. There was often little recourse beyond personal appeals or protracted, unreliable legal battles in foreign jurisdictions. A unique and often terrifying aspect of this reliance on trust was the concept of social capital and its direct financial value. Beyond mere reputation for honesty, a banker's web of influential friends, powerful family connections, and even strategic marriages contributed directly to his creditworthiness and ability to secure large loans or deposits. Losing a powerful patron or having a key family member fall from grace could instantly reduce your bank's perceived reliability, leading to a rapid withdrawal of funds. It meant your personal life, your family's alliances, and your social standing were inextricably linked to your bank's financial health, making it a profoundly personal and vulnerable enterprise. Historians still debate the precise mechanisms by which social capital translated into financial leverage in Renaissance banking, but its importance is undeniable. Then there was the constant danger of falsehood and deception. In a world of slow communication, it was easier for unscrupulous individuals to create fake bills of exchange or to pretend to be agents of reputable houses, while bankers developed intricate methods of verifying signatures and using coded language in their correspondence. The risk of sophisticated fraud was ever present. A single forged document, successfully passed, could lead to a significant loss that might not be discovered until weeks or months later. You were constantly on guard, scrutinizing every document, every messenger, every promise. It was like living in a perpetual game of high-stakes poker, where you couldn't fully trust the cards or the players. You might even prefer the straightforward peril of sailing through pirate-infested waters, where at least the threat was clear and visible. The absence of modern auditing practices also amplified the tyranny of trust. While double-entry bookkeeping was emerging, external audits were rare or non-existent. This meant that the financial health of a banking house was largely based on the word of its partners and clerks. Internal fraud, embezzlement, or simple incompetence could fester undetected for long periods, only coming to light when it was too late to prevent a catastrophic collapse. You were trusting not just external parties, but also your own employees and family members with the vast fortunes entrusted to you. Consider the psychological burden of this system. Every new client, every new correspondent represented a leap of faith. You constantly assessed character, weighed rumors, and searched for subtle cues of reliability. The stakes were incredibly high, meaning that stress and paranoia were constant companions. A rumor of a rival's insolvency, even if unfounded, could trigger a bank run that spread like wildfire. The constant need to maintain an impeccable reputation and to scrutinize the reputations of all your counterparties was exhausting. Even the simple act of using correspondents in distant cities was an act of trust. These individuals, often independent agents, held your funds and managed your transactions far from your direct oversight. You relied on their honesty, their competence, and their loyalty. Any breach of this trust, whether through negligence or malice, could lead to significant losses. Your control was largely illusory, a fragile network of personal relationships strung across a continent. Ultimately, Renaissance banking, for all its innovation and grandeur, was terrifyingly reliant on the tyranny of trust. Without robust legal frameworks, rapid communication, and centralized oversight, the entire system was a fragile edifice built on personal relationships and reputations. One broken promise, one act of dishonesty, or one unforeseen disaster affecting a key individual could send ripples of ruin across vast distances, reminding everyone that in this terrifyingly interconnected world, your fortune was only as secure as the word of another. It was a testament to both the audacity and the vulnerability of human ambition. You've seen how trust, or the lack thereof, could unravel fortunes. Now, let's turn to a more primal, uncontrollable force that repeatedly shattered the fragile world of Renaissance banking, nature's cruel hand. Imagine building a vast financial empire, only to see it crumble, not from war or default, but from the unseen ravages of plague, the relentless grip of famine, or the fury of a devastating storm. These were threats that respected no wealth, no power, and could plunge entire regions, and by extension, your banking operations, into horrifying chaos. The most terrifying of these natural calamities was, without a doubt, plague, the Black Death in the 14th century, and subsequent outbreaks throughout the Renaissance. Decimated populations across Europe. Imagine a city like Florence, a bustling center of commerce and banking, suddenly becoming a ghost town. Merchants died, debtors vanished, and the entire workforce from clerks in your bank to laborers in the fields was decimated. If your clients died, who would repay their loans if your agents perished? Who would manage your distant branches? The plague didn't just kill people, it killed economies. When a plague struck, trade routes would grind to a halt. Goods couldn't be transported, markets closed, and the flow of money ceased. Ships might be quarantined for weeks, their valuable cargoes rotting in the holds. This meant a sudden, catastrophic loss of revenue for bankers who relied on commissions from trade and the constant movement of capital. Your carefully constructed network, designed to facilitate commerce, became a liability, its arteries choked by disease and fear. You might find yourself locked inside your villa, desperately trying to protect your family, while the very foundation of your wealth disintegrated outside your walls. Then there was famine in an agrarian society. The success or failure of the harvest dictated the well-being of entire regions. A severe drought, Prolonged floods or an early frost could wipe out crops, leading to widespread starvation and economic collapse. And if peasants couldn't produce food, they couldn't pay their rents or their taxes. If merchants had no goods to trade, their businesses faltered. And if nobles lost their income from their lands, they couldn't repay the enormous loans they had taken from your bank. Famine, much like plague, was a slow-motion disaster that systematically eroded the solvency of your clients and the stability of the economy. A unique and particularly cruel aspect of these natural disasters for bankers was the sudden, unrecoverable nature of the losses. Unlike a defaulting prince, who might eventually repay or whose assets could be seized, a dead debtor could not be pursued. A destroyed crop yielded no revenue. These were losses that simply vanished, leaving a gaping hole in your ledgers with no hope of recovery. This meant that even the most prudent banker, with a diverse portfolio and cautious lending practices, could be brought to the brink of ruin by forces entirely beyond their control. Historians still debate the specific long-term demographic and economic impacts of recurrent plagues and famines on the development of Renaissance finance, but the immediate devastation they caused to individual banking houses was undeniable. Beyond plague and famine, less dramatic but equally impactful natural events pose constant threats. Severe storms at sea could sink entire fleets of merchant ships, taking with them valuable cargo that was often financed by bankers. If you had invested heavily in a particular shipment of spices or textiles, and the ship was lost to a gale, your investment was gone. There was no maritime insurance in the modern sense. You simply bore the full brunt of the loss. Imagine waiting anxiously for months for a ship's return, only for rumors to trickle in of a terrible storm and no sign of your vessel. That pit in your stomach was the true horror of natural risk. You might even wish for the simple, predictable stress of arguing with a stubborn merchant over a few florins. At least then, the adversary was human. Even on land, floods could destroy vital infrastructure like bridges and roads, disrupting trade routes and making it impossible for goods or messengers to reach their destinations. Earthquakes, though less frequent, could devastate cities, destroying homes, businesses, and killing clients and agents. These events, while localized, could have ripple effects that impacted banking operations across a wider region, paralyzing commerce and leading to defaults. The very concept of risk diversification, so fundamental to modern banking, was incredibly difficult in the Renaissance due to these natural threats. While you might try to spread your investments across different industries or geographic regions, a widespread plague or a series of bad harvests could impact every single one of your ventures simultaneously. You couldn't truly escape nature's reach. Its cruel hand could touch every corner of your financial empire, regardless of how well you diversified. Consider the psychological impact of living under this constant threat. You could be the most intelligent, shrewd, and well-connected banker in Europe, but a rogue wave, a cough in a crowded marketplace, or a patch of barren fields could wipe out everything you had built. This fostered a deep sense of fatalism, a recognition of your ultimate powerlessness against the forces of nature. It made every successful year feel like a temporary reprieve, every prosperous decade a miraculous defiance of inevitable disaster. Ultimately, nature's cruel hand was a terrifying, uncontrollable variable in the horrifyingly risky business of Renaissance banking. Plague, famine, and natural disasters didn't discriminate between rich and poor, powerful and weak. They swept through populations, decimated economies, and left behind a trail of ruin that no amount of financial acumen or political influence could avert. They were the ultimate reminder that for all their ambition and innovation, Renaissance bankers were ultimately at the mercy of forces far greater than themselves, making their pursuit of wealth a terrifying gamble against the very elements of life itself. You've seen how nature's raw power could devastate fortunes. Now, let's pivot to something born of human ingenuity, yet equally capable of wrecking a banking house innovation's double edge. Imagine developing powerful new financial tools designed to simplify commerce and expand wealth, only to discover they also open the door to unprecedented levels of risk, fraud, and catastrophic failure. This isn't just about progress, it's about the terrifying realization that every new solution can bring new, unforeseen dangers. The Renaissance was a period of incredible financial innovation. The very concept of banking, as we understand it, was rapidly evolving. We've discussed the bill of exchange, which allowed merchants to transfer funds across vast distances without physically moving gold. This was revolutionary, effectively a precursor to modern checks and wire transfers. It accelerated trade, reduced the risk of highway robbery, and allowed for much larger transactions. But with this increased efficiency came new vulnerabilities. Think about the bill of exchange again. While it solved the problem of physical transport, it introduced the risk of counterfeiting. Without modern security features, a skilled forger could create a convincing bill, draining funds from a distant correspondent. This meant bankers had to develop intricate methods of verification, relying on secret codes, watermarks, or the distinct handwriting of trusted agents. But even these precautions were not foolproof, and a successful forgery could lead to a significant, unrecoverable loss. It was like creating a perfect key, only to realize master lockpickers were just around the corner. Then there was the development of double-entry bookkeeping. This was a monumental leap forward in accounting, allowing bankers to track debits and credits meticulously, providing a clearer picture of their financial health. Before this, accounting was often a chaotic mess of single entries and personal notes, making it difficult to detect errors or fraud. Double-entry bookkeeping provided a powerful tool for managing complex financial operations, offering a level of transparency previously unknown. However, this very innovation had a double edge. While it could provide transparency, it also provided a sophisticated new method for concealing fraud. An unscrupulous banker or a dishonest clerk, armed with a deeper understanding of the ledger, could manipulate entries, create false accounts, or siphon off funds in ways that were much harder to detect with rudimentary accounting methods. The more complex the system, the more intricate the ways it could be exploited. Historians still debate the extent to which early adopters of double-entry bookkeeping fully grasped its potential for both transparency and sophisticated deception. But the increased complexity certainly presented new challenges for oversight. Consider the growth of complex partnerships and branches. As banking houses expanded beyond their home cities, they established branches run by family members or trusted partners. This allowed for greater reach and diversification of investments, but it also decentralized control and amplified risk. A bad loan made by a partner in a distant branch could sink the entire operation, regardless of the prudence of the central house. It created a situation where your fate was tied to the judgment and honesty of individuals far from your direct oversight. You were effectively placing your entire fortune in the hands of someone you only communicated with via infrequent, slow-moving letters. A particularly horrifying innovation was the concept of early forms of insurance and annuities. While these aimed to mitigate risk, they often introduced new ones. For example, maritime loans might include an element of bottomry, where the loan only had to be repaid if the ship returned safely. This sounds like an early form of insurance, but it was incredibly speculative and difficult to price accurately. Bankers might underestimate the risk of a voyage, or the moral hazard of a captain who might intentionally wreck a ship for the insurance payout. These rudimentary financial products were often based on guesswork rather than sophisticated actuarial science, making them incredibly dangerous. You might find yourself wishing for the simple, direct risk of knowing a single ship might sink, rather than the convoluted calculations of speculative loans. The rapid expansion of credit itself, fueled by these innovations, was a terrifying feedback loop. The bill of exchange made it easier to extend credit, which in turn encouraged more trade, which then demanded even more credit. This created an increasingly leveraged system where everyone was borrowing from everyone else, often with overlapping debts and obligations. When a shock hit, a war, a plague, a major default, the entire interconnected system was vulnerable to collapse, as the failure of one large borrower could trigger a chain reaction that took down multiple banks. It was like building a tower higher and higher without realizing the foundation was crumbling. Furthermore, the very nature of financial innovation meant that there were no established regulatory bodies or accepted best practices. Bankers were making up the rules as they went along, experimenting with new instruments and strategies without fully understanding their long-term implications. There was a constant race to be the first to adopt a new method, to gain a competitive edge, without the benefit of hindsight or collective experience. This Wild West atmosphere, while exciting for those who prospered, was utterly terrifying for those who fell prey to its untested dangers. The psychological impact of this constant innovation was a mix of excitement and profound anxiety. You were at the cutting edge, shaping the future of finance, but every new tool was a potential weapon pointed at your own heart. The faster you moved, the more complex your operations became, the higher the stakes. It demanded an unparalleled level of intellectual agility, constant vigilance, and a willingness to embrace change, knowing that change itself was fraught with peril. You were a pioneer, but pioneers often died first. Ultimately, Renaissance banking's innovations, while vital for economic progress, were a double-edged sword. They offered unprecedented opportunities for wealth and expansion, but they also introduced new forms of risk, complex interdependencies, and novel avenues for catastrophic failure. The very tools designed to mitigate old dangers often created new, more insidious ones, making the pursuit of riches a terrifying, intellectually demanding, and ultimately, horrifyingly risky business. You've witnessed the perilous promises of wealth, the treacherous tangle of credit, and the double edge of innovation. Now, prepare for the most dramatic and devastating consequence of these accumulated risks, the fall of giants. Imagine the shockwaves that ripped through Europe when a banking house, once a pillar of stability and a symbol of immense power, suddenly collapsed, dragging entire cities and countless smaller fortunes down with it. These weren't mere business failures. They were economic earthquakes that reshaped the very landscape of Renaissance finance. The most infamous examples of such falls are the Florentine banking families of the 14th century, particularly the Bardi and Peruzzi. For decades, these families had been at the forefront of European finance, lending vast sums to monarchs, popes, and merchants across the continent. Their network of branches spanned from England to Cyprus, and their wealth seemed limitless. They were the equivalent of today's multinational investment banks, but with far fewer safeguards. Their collapse was primarily triggered by the colossal debts of King Edward III of England. He had borrowed millions of florins from them to finance his protracted wars against France, the 100 Years' War. When Edward, facing his own financial woes, effectively defaulted on these massive loans in the 1340s, it sent a mortal blow through both banking houses. The sheer scale of the outstanding debt was simply too large for them to absorb. The horrifying part was the domino effect. The Bardi and Peruzzi had, in turn, borrowed from countless smaller merchants, wealthy families, and even ordinary citizens who had deposited their savings with the banks. When the news of Edward's default, and then the bank's inability to repay, spread, panic erupted. Clients rushed to withdraw their money, triggering massive bank runs, but there was no central bank, no government insurance to backstop the deposits. The vaults quickly emptied, and the once mighty banking giants declared bankruptcy. Imagine the chaos in Florence. Families who had entrusted their life savings to the Bardi or Peruzzi found themselves destitute overnight. Merchants whose trade depended on credit from these banks suddenly had their lifelines severed. Businesses failed, jobs were lost, and a wave of economic depression washed over the city. The collapse wasn't just a financial event, it was a societal catastrophe, destroying livelihoods and shattering confidence for generations. Historians still debate the precise socio-economic consequences of these Florentine bank failures on the broader European economy, but their immediate impact on the lives of ordinary people was undeniably brutal. A unique and particularly cruel aspect of these collapses was the personal ruin of the banking families themselves. These weren't anonymous corporations. The Bardi and Peruzzi were prominent families, their names synonymous with wealth and power. When their banks failed, their personal fortunes were seized, their lavish homes confiscated, and their social standing utterly destroyed. Imagine being born into such a powerful lineage, only to witness your family's centuries-old legacy crumble to dust in a matter of months, leaving you and your relatives disgraced and impoverished. It was a public and deeply personal humiliation, a stark warning to all who dared to play in the high-stakes world of finance. You might find yourself wishing for the simple indignity of a public whipping rather than the complete erasure of your family's name and fortune. Another horrifying example is the later downfall of the Fugger family in the 16th century, based in Augsburg, Germany. The Fuggers were arguably even more powerful than the Medici, acting as bankers to emperors and kings, financing entire wars, and owning vast mining operations. Their collapse, though slower and less dramatic than the Florentines, was equally significant. Their immense wealth was tied up in loans to the Habsburg monarchs, particularly to Charles III and Philip II of Spain, who consistently defaulted on their massive debts. The sheer scale of the Spanish crown's military expenditures and its repeated bankruptcies slowly but surely bled the Fugger Bank dry. The Fuggers' fall highlights another terrifying aspect, the insidious nature of prolonged systemic risk. It wasn't a sudden, single default that brought them down, but a relentless erosion of their capital due to unreliable sovereign debtors. Despite their immense influence, their careful management, and their diverse investments, they couldn't escape the tyranny of their most powerful clients. Their gradual decline was a slow, agonizing death, a testament to the fact that even the most powerful bankers could not withstand the relentless pressure of royal insolvency. These spectacular failures served as brutal lessons. They taught subsequent generations of bankers about the dangers of over-reliance on single, powerful clients, the perils of long-term sovereign debt, and the vital importance of liquidity. They forced a reevaluation of risk, leading to more cautious lending practices and a greater emphasis on spreading investments. The fear of becoming the next Bardi or next Peruzzi lingered in the minds of future financiers, a chilling reminder of the ultimate consequences of unchecked ambition and insufficient safeguards. The fall of these giants sent ripples beyond the financial world. It impacted political stability as monarchs lost their primary sources of funding. It influenced social structures as once powerful families lost their standing and new ones rose to take their place. And it permeated the cultural consciousness, inspiring cautionary tales and reinforcing a deep-seated distrust of large-scale financial institutions. Ultimately, the fall of these colossal banking houses was the most terrifying validation of Renaissance banking's inherent risks. They were not just isolated incidents. They were seismic events that demonstrated the fundamental fragility of a system built on nascent financial instruments, unreliable information, personal trust, and the insatiable appetite of war. The echoes of their collapse resonated for centuries, a grim, powerful reminder that even the most glittering promise of riches could, with horrifying speed and devastating consequence, turn to dust. You've witnessed the rise and fall of Renaissance banking giants, their ambitions soaring to dizzying heights, only to crash spectacularly under the weight of myriad risks. Now, as our journey through this horrifyingly risky business concludes, let's reflect on a legacy of lessons. Imagine how the brutal experiences of these early financiers, their innovations, their failures, and their sheer audacity laid the groundwork for the financial systems that shape our world today, echoing through centuries of economic evolution. The most immediate lesson learned from the catastrophic collapses of houses like the Bardi and Peruzzi was the dire peril of excessive sovereign debt. Bankers slowly, painfully, began to understand that lending vast, uncollateralized sums to monarchs was an almost guaranteed path to ruin. Kings, with their absolute power and constant need for funds, were simply too unreliable. This led to a more cautious approach to royal loans, forcing monarchs to offer more tangible collateral or to seek funds from a wider, more diversified pool of lenders, diminishing the singular power of any one banking house over a sovereign. Another crucial lesson was the absolute necessity of diversification. The great banking families often tied their fortunes too tightly to one major client like a king or one particular industry like textiles. When that client defaulted or that industry suffered a downturn, the entire bank would collapse. Future bankers began to spread their risks, lending to a wider variety of merchants, investing in different commodities, and opening branches in numerous cities to mitigate the impact of localized economic shocks or political instabilities. This foundational principle of not putting all your eggs in one basket was born from the ashes of spectacular failures. The terrifying bank runs of the Renaissance also taught a stark lesson about liquidity. Banks needed to ensure they always had enough ready cash on hand to meet immediate demands from depositors, even if their total assets far exceeded their liabilities. When confidence evaporated and everyone rushed to withdraw their money, a bank could be perfectly solvent on paper, but still collapse due to a lack of immediate cash. This understanding paved the way for future banking practices that prioritized maintaining sufficient reserves and developing methods for quickly accessing funds in a crisis. You can almost see the medieval bankers sweating, trying to count every coin, praying it would be enough. The proliferation of the bill of exchange, despite its early risks, became a cornerstone of international trade. The early problems with counterfeiting, communication delays, and legal enforceability pushed for improvements. Over centuries, these instruments evolved, incorporating more security features and becoming more standardized. The concept of transferring funds and credit across vast distances without physical cash, refined through painful trial and error, is the direct ancestor of today's electronic fund transfers and credit systems. The horrifying complexity of medieval paper transactions gave birth to the seamless digital world you inhabit. A fascinating, long-term echo of Renaissance banking is the development of formalized risk assessment. While early bankers relied heavily on intuition and personal connections, the sheer scale of their failures forced a more systematic approach. They began to understand the importance of evaluating a borrower's creditworthiness more rigorously, assessing geopolitical risks, and even trying to quantify the dangers of natural disasters. This nascent informal risk management was a crucial step towards the sophisticated financial modeling and risk analysis that underpins modern banking. Historians still debate how explicit or formalized these early risk assessments were, but the stark consequences of ignoring risk certainly taught a painful, indelible lesson. The personal nature of debt and default, and the brutal consequences of debtors' prisons, eventually led to the development of more structured bankruptcy laws. The Renaissance saw the beginnings of procedures for creditors to collectively claim assets from a failed debtor, rather than resorting to individual vengeance or endless imprisonment. While still harsh by modern standards, These nascent bankruptcy frameworks were a direct response to the chaos and personal ruin caused by unmanaged defaults, aiming to provide a more orderly, if still painful, resolution. You might even find yourself preferring the impersonal, regulated processes of today's financial world to the high-stakes, life-or-death gambles of the Renaissance. The intense competition and rapid innovation of Renaissance banking also fostered a culture of financial ingenuity. Bankers were constantly seeking new ways to make money, manage risk, and facilitate trade. This relentless drive for innovation, though fraught with danger, laid the intellectual groundwork for complex financial instruments, investment strategies, and market structures that would emerge in later centuries. The bold experiments of these early financiers, even their mistakes, were valuable data points for the future of finance. The ultimate legacy of Renaissance banking's horrifying risks is the profound understanding that finance is intrinsically linked to trust, information, and governance. The failures demonstrated that without reliable communication, transparent accounting, enforceable laws, and a degree of political stability, even the most brilliant financial innovations can collapse. These painful lessons spurred the development of stronger legal systems, more standardized accounting practices, and eventually, the very concept of central banks and regulatory bodies designed to bring order and stability to the inherently volatile world of money. So, as you drift off, consider the echoes of these long-vanished giants, the Medici, the Peruzzi, the Bardi, the Fugger. Their stories of terrifying risks, spectacular successes, and devastating falls are not just historical footnotes. They are the foundational cautionary tales that shaped the very rules of the financial world we inhabit. Every time you make a secure online payment, every time your bank deposit is insured, every time a company's financial health is transparently audited, you are experiencing the quiet, enduring legacy of the brutal lessons learned in the terrifyingly risky business of Renaissance banking. Their horrifying experiences made your financial world a little less horrifying, and for that, perhaps you can rest a little easier tonight, now that the tales of knights and their servants have died down. Let your mind wander past the cold stone walls and dusty battlefields. Feel the peace of the night slowly envelop you, bringing with it the stillness of a long journey. Let the images of gleaming armor and challenging adventures fade gently from your mind. There is no more pressure or fierce battles, only the calm of darkness and the invitation of deep sleep. Release all tension and allow your body to rest. The worries of the day are gone, giving way to peace. You have listened to a tale of courage and perseverance. Now it is time to let those lessons gently drift into your dreams, blending with the gentle sounds of the night. Let yourself drift away into a deep sleep where beautiful dreams await. Good night.